I want you to think about a time where you wish you had the option to work part-time, that you had the option to quit the 9 to 5, and that you had the option to buy nicer things in life, or to pay off that mortgage at a faster rate. Well, to have these options, many of us chase down what we call passive income. And today, I'm going to show you how to obtain the passive income through dividend investing in the stock market. Now, during my short investment journey, I've definitely learned a lot along the way. And you definitely learned a lot about yourself when you're putting your own hard-earned money on the line and experience the pros and cons with each of the methods and psychologically how you react to risk and fluctuations within the market. And I've already tried property and I've moved away from it. Links to that video will be below in the description box. And what I found out is that I'm most comfortable investing in dividend-paying stocks which will provide me a cash flow. Now, dividends are one of the most easiest ways to estimate your cash flow throughout the year. And whilst they do fluctuate, it's a great way to compound your wealth over many years as the dividends come in per quarter, biannually, or monthly, and that gets reinvested to buy you more shares. This then creates a snowball effect which can provide a massive source of passive income for you being a shareholder of a given company. So before we get any further, I think it's important to define what is a dividend. Now, as a shareholder, you are entitled to a portion of the company's profits which can be paid out monthly, quarterly, or biannually. And in Australia, most commonly it's biannually, but I understand in the States that it's quarterly. These biannual payouts are known as the interim dividend and the final dividend, and act as an incentive for investors to put their capital into a company, generally one that's well established. Here's an example of one. In Australia, most of our banks pay a 6 to 8% dividend yield. However, if you look at the share prices over the years, they haven't moved very far at all. This is with the exception of CBA. Due to the lack of growth, the banks are willing to pay big dividends to ensure investors stay. And if you think about it, you can only repackage lending so many times before you run out of people to lend to, or there's no movement in the market to create any form of demand in housing or anything that requires a loan. So you can't just create demand out of thin air like some of these new tech companies can, because you can only do things a certain amount of times in these older established companies. The dividends that are paid to investors are also paid by what's called a per share basis. Basically, you get paid on the amount of shares you have. So for example, a share might give you an interim dividend of $1.99 and then a final dividend of $1.99. And you can understand this easier by looking at the total shares of a company as a whole pie and you owning a very small slice of that pie. Now, to get more money out of the company and to get more of its profits, you essentially just have to increase your shares of the pie that you own in the company to become a bigger shareholder and thus getting a greater profit. Now, as an investor investing in dividend-paying shares, it's quite important to understand a few dates. Initially, the date when the register actually shuts off and then looks at which shareholder is entitled to a dividend, and secondly, the date when the dividend is actually paid out to the shareholder. This, of course, becomes a little less irrelevant when you're investing for a couple of years, because no matter what, the dividends will come in quarterly or biannually to the shareholder. So in Australia, a record date is at 5 p.m. on the date that the company closes its register to determine which shareholders are entitled to receive a current dividend. In Australia, we have what's called an Ex Dividend date, which generally occurs a business day before the record date. And during this time, the share price generally goes up. And that's because people are quickly rushing in to purchase the shares to receive the dividend and then quickly sell off the shares after the ex-dividend date, which is when you see prices of shares dip a little. Now, once that's all complete, you get what's called the date payable, which is a day that dividends are actually paid to the entitled shareholders, which at this point may not even hold a share. Now, we mentioned before that dividends are paid from the company's net profit. However, not all companies pay a dividend. So what exactly do they do with the profits? When a company earns profits, they generally have a few options to exercise, which are generally in the benefit for the company or the shareholder. First being that the profit is reinvested into the company in seek of expansion. And expansion can come in the form of purchasing more branches, doing more research and development, or advertising that can be done to push the business out there to have more people using their services or products. You generally see this in companies like Nike and giants like Apple, Google, and Microsoft, where it's reinvested in research and development to come out with newer models of phones or shoes that benefit the end user. They can also use the money to pay out any outstanding debts that the company owed. This has a result of showing a better balance sheet and increasing their future net profits, which can go into expanding the businesses or getting passed on to the shareholders as opposed to paying it out in interest in debt. Having lower debts also makes the company more attractive to the shareholder and generally boosts the value of the shares. However, it's important to understand that most companies will actually operate on debt because it's a better way of leveraging their money and resources as opposed to using their immediate capital to fund any research and development and not having that as an emergency fund in purchasing future acquisitions of smaller companies or using it to pay off some more immediate debt. They can also use the net profit to repurchase many of their shares back. Now, to best understand this, we have to go back to the big pie analogy and look at all the shares as small slices of pies. Now, if there's more of them out there, then the shareholder shares are actually smaller portions of that pie. But when shares are repurchased, the slices become a bigger portion of the pie because there are less of them out there in the market. And in turn, if people are now looking to buy your share of the pie, they're going to have to pay a greater price for it. And Apple did a great job of this in 2008 by boosting shareholder value when they repurchased a large portion of their share and ultimately increased shareholders' values. So there are many ways a company can use their net profit, and the most important aspect is that they're making net profits in the first place. Because if there's no profits, then that means there's no cash flow to be used and the company is actually operating on debt in most cases. Now, when talking about dividend investing, the dividend yield is the first thing that generally comes to people's mind and something that they consider before purchasing the share. Now, the yield is a good indicator of your expected return on the money that you put in. However, it could also be very misleading to a new investor on investing into the company because there's a multitude of facets when you're looking at a good operating business as to how they operate and how they become successful over time. So in saying that, high dividend yields don't automatically mean that the company is a stable company, that they're creating profits and they have a good cash flow, because it could mean that there's been a moment in time where their share prices have dropped drastically, which then increases what the yield actually is based on their dividend payment previously. And in fact, sometimes this should alert you to the fact that there's low potential growth because the money is not being reinvested into the company, and instead the dividend yield is being used to incentivize the shareholder to put their capital in the company. In saying that, Australian shares tend to have a higher dividend yield than others around the world. However, in my opinion, we've also gone through a 20+ year bull market, except for in 2018 during the GFC, but we recovered from that within a few years. And dividends continue to keep going up every couple years. In terms of investing, I tend to look at how the company makes money and if it's sustainable and make my decision accordingly. There isn't one single facet that I look at to determine whether the company will be successful, but instead a multitude of factors like I mentioned before, and the economy as a whole in Australia and which market they're tackling, and whether there will be a continuing need for that. Now, in contrast, low dividend yields don't automatically indicate bad companies. There are many tech companies like Afterpay, who don't pay a dividend, A2 Milk, who don't pay a dividend, and many other tech stocks who don't pay any forms of dividends that have gone up over 300% within the last decade. Now, this is the payoff in the future due to the explosive growth that these tech companies have, which is reflected within the share price, as opposed to just being paid straight out to the shareholder. And given that there are low to no dividends that are paid out in these stocks, a lot of research has to go into the stocks to understand whether the market's going to be there in the future and whether there's going to be a need or a demand for their services and products, which will greatly dictate their growth. Now, the last and most important aspect of investing in dividends is the compounding effect that it has over decades. Now, I think this is something that people look at and talk about, but it's largely overlooked in general. Now, talking about growth in the future, the most important aspect of investing is that you do it as soon as possible and take full advantage of the compounding interest. As a way of demonstrating the compounding effect, let's say you start investing $500 a month at 22 and you're receiving a 6% on your return in dividends a year. In the first year, you'd receive $360 in dividends. Now, that doesn't sound like much in the first year, but let me show you the effect that it has by the time that you're 60. Now, this is obviously in the lower end of investing. If you get really good at saving and go really hard in investing, by the time you get up to $100,000 in the stock market at a 6% return, you're looking at $6,000 per year paid out to you as a shareholder in dividends, which you haven't had to work for. Doubling that will generate you $12,000. And although this is going to take some time, I want to provide a bit of context to somebody who's working a 9 to 5 and what $12,000 can actually do. So for somebody earning an average salary of $70,000, that $6,000 is a month's worth of pay. That's an extra month's worth of pay that you didn't have to work for and that you're receiving passively. Now just imagine what an extra $6,000 could do. You could take a summer holiday, save what you earn and reinvest it, or continue to reinvest it into the stocks and compound your wealth. Get it? Compounding interest, you got it? Okay. And just remember that you're receiving this $6,000 just for being a shareholder and nothing else. So there's no maintenance, there's nobody calling you up, interrupting you for any type of reason. You don't have to answer to a bank. There's no loans attached to it unless you're doing margin calls. Don't do margin calls. The only thing that you really have to be wary about is fluctuations in the share price, which is generally a result of the practices of the business. So if things go sour in the business, then share prices will go down. And just likewise, if the market and the economy isn't doing so well, then the share prices will tend to follow the market and the economy as a whole. And by the time you've reached $200,000 in investments, you'll now have $12,000 worth of income. So you're essentially now covering 2 months worth of pay. And again, you can do whatever you want. Whatever you want with the money.
What am I gonna do?
Now just think about it. That's $12,000. For most people, that'll cover their personal expenses minus rent and mortgages. Now when I tell my friends and colleagues about this, the thought of investing $100,000, $200,000, $1 million plus to replace their annual income can seem a bit daunting, and I understand that. Especially when you only have about $5,000 to $6,000 a year to invest, and your annual returns is a couple $100s. But we need to remember the aim of the game is to actually have your wealth be compounding over decades, which will bring you that passive income in years to come. And it's only after those decades of investing, of saving and investing, and reinvesting those dividends is when you're actually going to start to see a big amount of passive income come through your dividends, and that's where you're going to see those options that we were talking about at the beginning of the video come to fruition. And these will be options that you can exercise to live a life that you want to live. And if you've made it to this point of the video, I want to say thank you. Please make sure you smash that like button. Subscribe if you want to see some more videos. And let me know what you want to see below and your thoughts on dividend investing. I'd love to make some more content on dividends, maybe on the tax implications, and some stocks that I'm looking at in terms of dividends. Just let me know in the comments below, and I hope to see you guys soon.